Now, on this channel, we discuss tax and accounting matters, we discuss compliance, and we discuss issues relating to your profit, your business, and your ability to remain in business. Very important. Let me just get myself ready while we're waiting for people to arrive. I am just going to take off my glasses for a minute and hope that as soon as they're back on, we are ready. I think we're just about ready. So, for everybody that's connected and those that will connect a little bit later on, this channel will help you. Please, will you also go and you will see our other videos. You'll see videos that will help you with your taxes, with your profit issues, all sorts of things. And you'll be able to watch those videos. Please also subscribe. You will find it very helpful. Welcome to Patricia. Thank you for letting us know that you are here. So if you need help running your business, you need help being able to determine your profits, you need help with compliance issues, we are your people. Please subscribe. Please also, when you connect today, like this broadcast so that we can have it go further and further and connect with as many people as possible. So we are a community. If you look back, you'll see that most of our live videos are being watched after the fact, so they're still getting out there. And I'd like to welcome those of you who are still coming in and those that are joining. Every Thursday, 10 a.m., we are here. Hi, Narupa. Hi, Kimira. Welcome. Every Thursday, we are here at 10 a.m. We were originally doing a 7 p.m. Similar segment, but in the last few 2 or 3 weeks, we've just only been doing the morning one. It was getting a little bit hectic. So, welcome again, and I think I'll just wait for a few more people to join, and then we will start our topics for today. So you'll notice what I try and do is I try and cover the basis for self-employed people and business owners, but I also try and talk to those that are just individuals, employed people, salaried people that need to know a little bit more about tax and a little bit more about how to run a business, how to run your own business. Remember, even you as an individual getting your salary at the end of the month, you are running, in a sense, a business. It's just not a business in the sense that other people that are out there are running their businesses and making profits, but you are receiving income in the form of a salary. You are making payments. You are paying taxes. You are, hopefully, you have a budget. You're able to see how well you're doing in terms of actual versus budget, and you're making savings. So, in a sense, you are a business owner in your own right. And that's why I always say to people, you are practicing. In a few years and a few months, you may run your own business. You've already had practice. Okay, I think we're ready to start. We have enough people now. So let me introduce myself. My name is Carol, based in Johannesburg, South Africa. So I am a tax practitioner, professional accountant, and a corporate governance specialist. On this channel, we discuss tax and accounting matters. We discuss compliance. We teach you how to run your business, how to grow your business, how to be productive, how to be profitable. And we will be looking at different aspects. So please do join us. Every Thursday, 10 a.m., we are here. Let me start. I think we have enough people for us to start now. Please like the channel. Please also share it if you have someone who might benefit from this. And please watch our other videos. And last of all, subscribe. You will get notifications if you are a subscriber. So today we're going to go just a little bit deeper in the personal tax, and then we're going to go into the business aspect. And as I say, you might know some of this, but I will also bring you a few things that you might not know. So, as a personal taxpayer, here you are, you've received your IRP5 from your employer. By the way, if you haven't received your IRP5, it's still not too late. The deadline is still quite a way off. You've still got until October to file. And it's not wise for you to file without your IRP5. So you must get that. Okay, so once you filed your tax return, whenever it is that you're filing your personal tax return as an individual, if you're employed, no other income, no other expenses. Remember, you're not, if you have a salary, you can't just start bringing in other expenses in order to get a refund from SARS. They're quite clear and quite strict about that for the past 2 years. If you're a salaried employee with an IRP5 and a payslip, then they do not expect you to be claiming things like your telephone, your insurance, because they're expecting you to pay that out of your salary. It's got nothing to do with your tax return. It's got nothing to do with a refund, because you're not running a business from the tax point of view. You are earning a salary. Therefore, those expenses that you are paying are nothing to do with SARS. It's only in a case where you have a specific contract from your employer that it forces you to work from home. So SARS has actually been asking to see these contracts. Basically, these contracts would say that this person needs to work from home. It's part of the contract that they're working from home. And if they're working from home, then they need to incur certain costs that the company is not paying. So this is where you would now have your home office expense, because then the company would say, take care of your own Wi-Fi, for instance, take care of your own telephone bills. And those are generally expenses that any office would have taken care of. But because you are working from home, you are paying them on your own, and therefore you should be compensated tax-wise. That is the only instance in which you would have an easy time claiming home office expenses if your contract specifically said that. And the reason why SARS has become strict about that is because most people were just wanting to say, listen, I earn a salary, but I also want to claim my expenses. And of course, if you're not supposed to be working from home, then you can't just claim those expenses. So I just wanted to run that by you. The other thing, you have medical aid and you have retirement annuity. We've spoken about those credits. We've spoken about the fact that people who get refunds are generally people who have credits from medical aid and from RA. And remember, you can either get those credits on a monthly basis, in which case your tax would be reduced on a monthly basis, or you can wait until you submit your return at the end of the year, in which case you would then just get a refund. So there's two options here. And there is a cap on both the medical aid and the retirement annuity. You're not just going to get your full amount that you're paying regardless back from SARS. There is a cap. So I think as far as the personal tax is concerned, I'm not going to go too deep today, but I will just add one more thing. A lot of you ask about the logbook and about travel allowance. What happens is, if you as an employee are getting a travel allowance from your employer, the understanding or the expectation is that you are using that travel allowance from your employer to use your personal car and to travel and on business. So remember, business is not home to the client. That is private. But they're expecting you to go from client to client and to actually be doing work and be recording that mileage. You need to specifically have a logbook, and that logbook must be the same logbook that SARS has prescribed. So it must have an opening balance, it must have details of the client, where you went and who it was, the mileage, and of course the return trip as well, and then it'll have your closing mileage as well. So it's quite a detailed book, the logbook. Please make sure you use the correct one. And if you have a logbook, then that means you can justify the travel allowance that you were paid. Let me ask you, do you know why travel allowance is so important? I'll tell you. SARS does not, let's not use the word SARS. As an individual, you are not taxed on your entire travel allowance. That's why SARS has a special interest. They only tax you on 20%. So if you're getting a travel allowance of 10,000 Rand every month, that means you're not being taxed for 8,000, which is a lot. So they are very careful to check whether you're actually doing client travel, because you're not being taxed for 80% of that. If you cannot prove that you went to visit clients and you had travel that was recorded on a logbook, then you will be taxed. You will now all of a sudden be owing SARS. A lot of people have this problem where they've submitted their tax returns, they had travel allowance, and the IRP5 stated that they had a travel allowance. When they submit their tax return, SARS will then come back to them with correspondence and say, please submit your logbook so that they can see exactly where you traveled. They also need details of the vehicle, the cost of the vehicle, because there's a calculation that they do. They need to know when you bought it, what is the make of your vehicle, and all that sort of thing. So if you cannot provide your logbook as an attachment with details that are satisfying to SARS, then they will just reverse the fact that the travel allowance was tax-free, and you will be taxed on the full amount. And that's why most people end up owing SARS when they can't provide the logbook. So 9 times out of 10, people that have a travel allowance, they owe SARS because they have not provided a logbook. If it's too late, and SARS has already asked you to pay in because you failed to provide that logbook in the stipulated time, then you can't now go back and adjust that return. You now have to do what we call an objection. And of course, if that objection doesn't go through, you have to do an appeal. Please also note that there is a prescription period. You can't now in 2026 try and do an objection for a travel allowance on a year when you submitted, let's say, 2021. That's not going to work because it's the prescribed period of 3 years has passed. So what am I basically saying here? I'm saying when it comes to your tax returns, you've got to be very diligent. Once you submit your personal tax return, you've got to go back in and check, is SARS asking for something extra, supporting documents? And usually within 24 to 48 hours, there will be an immediate request if they are going to ask. If there's nothing required, initially, you need to go back in and continually check in case it's audited at a later stage and documents are required. Because if you fail to submit what they're asking for within the required time, then all you're doing is asking for trouble. Okay, so I think on the personal tax return, I have given you enough for today. I'm now just going to talk on in a business sense for someone who's operating a business or someone who is working in a business, all the little things that we want to discuss today. So today, I want to talk to you about something that we call cash flow and a forecast. And it's similar to a budget, but it's slightly different. If you are going to apply for a loan as a business, 9 times out of 10, you will be required to submit financials. Right? Why? Because the bank wants to see, number one, affordability. Are you making profits that are high enough to be able to pay them back their loan? Because they're interested in you being able to pay that loan. If you don't pay that loan, of course, that will affect them. Hi, Nompilo, welcome. And hi, Belinda. I'm not sure if I had greeted you yet, but welcome to today's session. So if you are running a business and you are trying to borrow funds from any institution, the first thing they'll look for is financials. If your financials, let's say your year end is Feb, and you are now trying to borrow money in September or October, November, or any time after Feb, 9 times out of 10, the institution, in addition to financials, will ask to see management accounts because the financials are up to a specific date. But they need to know since then, since that year end, they need to know what has happened. What money have you made? Have you made a profit? How far have you gone? So you will need to still do management accounts. And management accounts typically will go from whenever you ended the financials, which in most cases would be from the 1st of March, up until a much more recent period. So it's important that you gather all your bank statements. Now, here is where the problem is. A lot of people do not get their bank statements coming through from the bank on a regular basis. So now when they need to do financials and management accounts, bank statements are not available. Please make sure that you are gathering your bank statements. Number one, you need to know what has gone through your bank. If there's an error, for instance, or the bank has duplicated a payment, you might not even notice if you don't see your bank statement on a monthly basis. So please make sure you are receiving your bank statements on a regular basis and checking them. So that was just by the way, and it was a freebie. Back to what the bank requires. What the bank is looking for, and I'm going to tell you a few things that you need to make sure that on your financials you are taking care of. Number one, they need to see profits. If you're borrowing money from a bank, the bank cannot lend money to someone who's making a loss. It just wouldn't make sense. Even you wouldn't lend money to someone who is in a loss-making position, okay? So your statement of comprehensive income, which is the profit and loss, must show a profit. Not only a profit, but the profit must be high enough that when they factor in their repayments, you can still manage to pay them back. Okay, so obviously they're looking at the fact that as a business, you're able to take care of all your expenses and you won't then struggle to pay them back. This is why they need to see a profit. The next thing they'll look at is a statement of financial position. This is what we used to call a balance sheet. They need to look at what we call solvency. Solvency is defined as a status in which your assets exceed your liabilities. Therefore, you must own more, own, OWN, as a business than you owe, OWE. So in other words, if you have loans and you have creditors, unpaid suppliers, that value must be lower than your own assets. What are assets? Assets can be non-current or current. We're talking about your buildings, your vehicles, your furniture. Some people in assets, they have investments. Like if you have a company savings account, that is an asset, like an investment account, a 90-day account or whatever. Those are all assets. Assets can also be in the form of your debtors. In other words, you've invoiced clients, they haven't yet paid you. That is an asset, it's a debtor. You can also have your inventory if you're a business that keeps stock. So if your assets are higher than your liabilities, then that means you are solvent. In fact, I must tell you, if you are running a business where you are owing more than you own, then you are technically insolvent. And your accountant, when they do your books, is supposed to report you to say that you cannot run your business continually because you can't meet your obligations. So a lot of people, because part of their obligations is maybe a shareholder's loan, it's a loan to the director, they don't take it too seriously because they know it's not an actual loan. I mean, a loan to you as a director, you can write that off. You don't need to pay yourself. So that is what makes the distinction sometimes. So the banks look at that. They look to say, okay, is the company owing many third parties, or are they in a position where they are stable? If your company is in a position where they're owing the director, then it's not too bad. But there's another position that does not please most banks, and it doesn't please SARS either. That is a position where, as a shareholder or a director, you are actually owing the business. So in other words, we have a shareholder's loan or director's loan, which is in debit. So it means you as a director or a shareholder have been taking money out of the business and it's a loan and you haven't been paying it back into the business, and every year it keeps growing. I've seen instances where maybe the amount is even in millions or hundreds of thousands. Now, let me tell you, by law, tax-wise, that is not allowed. You cannot be owing your business amounts that remain unpaid. The reason being, SARS views it as if you're taking an unauthorized salary. It's as if you're paying yourself while trying to run away from paying tax. So it's like tax evasion in a sense. So please make sure that as a business owner, if you need money to run your personal expenses, do not just be taking out loans and leaving the company in a position where you owe it. If you take out a loan, please do try and pay it back within the same financial year. Because when we submit your financials to SARS and they see a debit balance, they can tax you on that. They treat it like a salary and they make you pay the tax. Back to our funding and looking for money at the bank. So we said that we need to see higher assets than liabilities. And that also shows that over the years, you've been making profits. So when the banks look at your statement of financial position, they can actually see a lot. They can see over the years if you've been making a profit or loss. They can see whether you've been owing people money over the years or not. They can see the change between the 2 years, which brings me to my next point, which is the cash flow. So this statement of cash flow is another very important tool for bankers or institutions. When they look at that, they can tell where most of your finances have been going, the movement. It basically tracks the movement between year one and year two, current year and the year before. It looks at what you were doing at the end of one year versus what you're doing now. So it looks at important key issues like your debtors, your creditors. It looks at your assets. Have you bought more assets? It looks at your loans. So it's tracking your cash flow, the flow of income. Remember, your financials don't necessarily tell you about the flow of income, but the statement of cash flow will tell you how your funds have actually been flowing into the business. And that, together with all the other things I've mentioned this morning, allows the bank to decide whether you're risky or not, whether you're high risk or low risk. Of course, they put these risks on a scale. They look at how risky it would be to loan you $1 million, R1 million. Now, all of this is usually not useful if they cannot see a projection. Most banks will ask to see a projection. I'll tell you, ABSA, in my opinion, one of the strictest banks that you'll ever have to deal with. If you're looking to borrow money as a business, and you're using ABSA, you're trying to get money from ABSA, get ready for a high jump because they're going to ask you for a lot of things. One of the things that these kind of banks will look for is a forecast. Now, these are thorough banks because they want to know, okay, this is how well you're doing now. What about the future? If we give you the money, what then are you going to do with the money? Say, for instance, you're in a car, you have a car dealership. I just did a forecast just the other day for someone who runs a car dealership. They want to know, if we give you 2 million rand, how many cars will you then be able to buy that you couldn't buy before? What does that mean in terms of your sales? How far are your sales going to go up? And how far are your expenses going to go? Are you now going to need a bigger space? Do you need now to have higher rentals? Are you going to need to hire more staff because you're selling more cars? Does that mean you'll be paying more commissions because your employees get commission every time they sell? Will that then mean even your bank charges are going up, your transactions? Are you going to have more advertising because you're selling more cars now? You're going to need to go all out now on advertising, Facebook and so on. You're going to need to pay for ad spaces. You're going to maybe need to bring in a marketing person, maybe part-time, full-time, all that sort of thing. So when you do your cash flow forecast, please be very careful. You are going to indicate an increase in income, right? Because you're earning more, you've received an injection, for instance. But you're also going to experience higher costs. If you don't reflect that, then your cash flow focus will be very skewed and you're going to show that you are going to have masses of underutilized income. And I've seen banks, institutions come back and refuse to loan a client money because of that, because they'll say, well, from what we can see, you're generating enough income, you are remaining with a positive cash flow of hundreds of thousands. So what do you need us for? We don't need to loan you money. So you need to strike the balance and say to yourself, here's what I need from the institution. Once I get that, it will enable me to buy so many cars or so many, so much bags of cement if you're in construction, for instance. And what will that mean? It will mean I'm going to have more costs. Even as a director, that means you can earn a higher salary and your other stuff. It means you might need a supervisor where you didn't have one before. It means you might have more sites. So you're going to have more petrol because you're going to need to travel from site one to another and inspect, that sort of thing. So make sure that you are keeping things in perspective. Do not have income going up, but your expenses is not showing the correspondence increase. Remember as well, if you are going to get funding, there'll probably be interest. You may need to pay interest on the loan. So factor in the interest. If you're doing a forecast, for instance, to pay back even the capital amount, include that. You're getting a loan of $1 million, you need to show that you will be paying back that loan. I've also seen SARS asking for clients to give a cash flow projection. Same thing now with SARS. Of course, if you are saying, I'm trying to apply for a payment plan, a deferred payment arrangement from SARS, and they say to you, show us your cash flow projection, it wouldn't make sense for you to show SARS a cash flow projection that shows huge amounts of money that you're making, and that even after paying out all your expenses, you are remaining with a fat, bottom line, you're making money. Because then why are you asking for a deferred payment arrangement if you're making so much money? The assumption is you're asking to defer your payment because you are making losses and your cash flow is not that great. So we don't expect to see your cash flow forecast showing profits. It should be showing maybe here and there small profits, but mostly losses, because that's why you're asking for a deferred payment arrangement. So in terms of the full makeup of what needs to be in your forecast, bear all of that in mind. Make sure that it makes sense. Now, some of you may be also wanting to buy maybe what we call capital expenditure, CapEx. In addition to your income and your expenses on the forecast, you also need to show that you will then be buying maybe a building, if you're planning to buy a building, or if you're planning to buy, I have a client who does logistics, so they were trying to buy trucks to as part of the business. Now you would then need to show that you will buy assets, you will buy these carrier haulage trucks, and maybe it may not happen in the first month or two, but by month 3, you will have made enough to buy this haulage truck, whether by loan or by you generating enough income to pay for it cash. So make sure if there's a planned capital expenditure, you show that after your expenses, to say, having made this much income, I will then utilize it to buy these kind of capital expenses. Remember, you do not want to show your capital expenditure mixed up with your expenses, because it's a different category. I hope that makes sense. So today, I think I just wanted to focus on those main points. But before we close, I'm just going to delve into another subject, which I think interests many people. So we're going to talk about VAT, and we're going to talk about the fact that there are so many different types of entities. And remember, you need to know whether the goods or the service you're providing fits into an exempt category, into a zero rated, or whether you are just supposed to be charging VAT. I'm simplifying the terminology here because I do not want you to be confused. What do I mean by that? There is a lot of exceptions to the rule. For instance, if you're running an Airbnb and you're VAT registered and you're charging VAT to all your stay, did you know that if someone has an extended stay, there's a difference in the VAT calculation? So someone comes and says, I'm booking for a month, I'm booking for 2 months. You can't just charge them 15% and that's it. You need to isolate the invoice to those individuals, because the VAT applied is very different from the VAT that you apply to your normal sales. The same if you are, for instance, maybe you are renting out premises and you're VAT registered. Remember, there's a difference in how you apply the VAT on a residential property, if at all, and the VAT on what we call commercial property. So you do need to make sure that you're getting the right information. And of course, here, because we're dealing with all sorts of people, it's not the right platform for me to give you the specific facts. But just know that you need to make sure you have all the right information. Another scenario I can bring up is if we have clients who are in the lending business, money lending. They're registered with NCR as credit providers. Remember, if I'm borrowing a loan from you for 20,000, you can't charge me VAT on the loan. You can only charge me VAT on your admin fee that you are charging me. So maybe that, whether it's 500 or 300 per transaction, that's what carries the VAT. Even if I'm doing debt counseling and I'm VAT registered, I cannot charge you on the capital amount. So there's so many little things. VAT is one of the most complicated animals on the planet. And you do not want to find yourself in a position where you've made a mistake. And there's also issues of export. or providing transport for export goods. Again, those may not be vetable. So you really need to know your industry. You need to know what the Vet Act says. How does it apply to you to make sure you're not doing the wrong thing? I think we bang on 30 minutes. We're at the end of our segment now. I hope you enjoyed it. I hope it was useful. If you're working for someone and you need to tell your boss, this is what you learned, please do. If you're running your own business, please apply. If you're an individual, again, apply. Put it somewhere. Send it to someone who might benefit and share this. Enjoy the rest of your day. Please don't forget to like, don't forget to subscribe, and share this. Enjoy your day and see you next week, 10 a.m. Invite somebody.